Hello everybody, this is Dr. G. Mallikarjun. Today we will talk about the rule in Clayton's case. This is basically a rule which is used for appropriation of money when someone pays money into the bank for payment of various dues, etc. What is the mechanism in which that money is appropriated is what is the essence of this rule in Clayton's case. Actually, what is Clayton's case? The Clayton's case is something which is Devines versus Noble. So we'll talk about, we'll see this aspect. So first, appropriation of money paid. The general rule of appropriation of money is the customer paying money into the bank will have a right to indicate how this money is supposed to be used, for what it is supposed to be used, whether it is supposed to be used for payment of this amount or the other, etc. The guidelines which the customer indicates will be the rule that will apply. Then second, the banker has the duty to use the money only for the purpose indicated by the payer. So in accordance with the purpose that has been indicated by the person who is paying money, the bank is supposed to be using the money. That the problem of appropriation comes where the customer owes more money than the money that he is deposited, and he has more amount of transactions of debit or more amount of debts due to the bank, and the money that he pays is inadequate to meet the total amount of debt. So into which account the money has to be appropriated would then be an issue. And if it is a running account into which this money is supposed to be appropriated, which is it that is which transaction is it supposed to be used for? The first transaction, the last transaction, or the transaction of an equal amount, etc. So those are the determining factors where the problem insofar as appropriation comes. Then what is the main consideration for bank while they are dealing with it is that they don't want any debt to be barred by limitation. Imagine the customer says that you pay this amount for the last amount that is due, and you don't appropriate it for the earlier amounts due, then automatically the bank would be worried because the limitation would continue to keep running. And if they don't file a case within the period, then they will be left with no remedy. So from that point of view, their intention is to ensure that any debt that is due from the customer or to the bank is not hit by limitation. Then all debt should be recovered by the bank. Then the rules of appropriation, as I have indicated, where there are more than one debts due and the money paid is not sufficient to pay all, the debtor making payment has the right to choose the debt to which the money paid is to be appropriated. And if he does not exercise the choice, then creditor has the power to exercise choice to make the appropriation. And if neither indicate how the money is supposed to be appropriated, it is in that case that the presumption of law as per the rule in Clayton's case will apply if neither the debtor nor the creditor indicates the order of appropriation. And what is the mechanism that is adopted? The first item on the credit side is used to pay the first item on the debit side. And the first item of debit is discharged by the first item of credit. So this is the general rule as far as Clayton's case is concerned. Now let us see an example how this operates. Imagine that there is a current account which is running in, which is an overdraft kind of an account where the entries are made. So on 1st of January, there is a 500 rupee entry, then 1000 rupees, 2500, 300, 1500, etc. So the total dues are about 5500, and on 11th, an amount of 200 has been paid, and on 12th, an amount of 4000 is paid. So here, while he is crediting the amount of 200 and 4000, the debtor can choose where this money is supposed to be appropriated. He can say that you strike off the amount that is there on 10th of January. Then the remaining amount, that is the next amount of 4000 rupees, you use it for paying out 9th January is 500, 8th January is 1000 rupees, and 4th January is 2500, so that the 4200 will be appropriated. Let the older amounts remain. So in this case, if the bank is agreeable that the bank has to be appropriating this amounts towards those transactions. Suppose the debtor does not indicate into which the amount is supposed to be appropriated, then the choice will be for the creditor. And what would his consideration be? His consideration would be that none of these debits which are dues owed by the customer should be barred by limitation. So what he would do is first appropriate it for say 200 rupees, 200, he will strike out those two transactions, but he will use the amount for 4,000 for first, second, and fourth. So this way he could have a choice in terms of which transactions he would appropriate the money into. But if neither the creditor nor the debtor uses the money, then the presumption of law, which is as per the rule in Clayton's case, which will apply. So here, the first entry of credit, that is 200, will be first appropriated to the extent of the first entry of debit. That is 500 rupees is the amount which is the first entry of debit. So from that 200 rupees will be adjusted and 300 will be remaining. Then the amount of 12,000 on 12th January, 300 will be first used for paying out the balance of 300 which was due after 200 has been appropriated. Then the 1,000 rupees, then 2,500 and 300 will be cleared. So the dues up to 6th January will be cleared based on this. So this application of first in, first out in terms of appropriating the payments, which is a rule, which is a presumption of law in terms of how it has to be appropriated. This is what is Clayton's case. Now let us see what is the case and what are the facts of the case. So the case is Devines versus Noble. So here this Devines, Daves, Noble and Company and Co. is a partnership firm with five partners. Devines was the chief partner. Daves, Noble, Kraft and Barbock were the other partners. And what was the business it was engaged in? It was engaged in the banking business. So automatically when you're doing banking business, you will have current accounts of customers, then you will be giving loans. So here, Nathaniel Clayton was the chief creditor of the firm with a current deposit account. Then the chief partner Devines died and the surviving partners carried on the business in the firm's name. That is Devines, Daves, Noble and Co. So this was in spite of the Devines sons and the trustees of Devines estate indicating to the the partnership firm that they don't want to be continued and they don't want the usage of the name to be continued. So without the consent and despite the notice of the trustees, the partnership continued in the same name and also continued to do business by the surviving partners. Then after a year, the firm became insolvent and the partners became paupers. So automatically the monies that are due are supposed to be recovered. So then the amount due to Clayton when Devines died was 1,713 pounds. So after that, he made withdrawals from the account and then he made further deposits into the account. Then the firm paid the money to Clayton in excess of 1,713, which was in account at Devines' death. So Clayton claimed from the estate of Devines. So this was the amount outstanding to his credit after the withdrawals have been made after the death, but before making any payments into the account. So a balance of about 4,453 pounds was the claim that was made. So the monies that were paid and the money that were deposited and taken out. So the amounts that were taken out was more than 1,713. Then deposits was also made. So Clayton demanded that he has to be paid out of the estate of Devines. Then the contention here was that the amount existed in the account at the death of Devines and at the time of insolvency of the firm. Since there was amount due that was there, it was payable by the firm and the deceased partner's estate was liable to that extent. Then he withdrew the amount after Devines' death only from the money deposited by him after the death. So whatever money he has deposited after the death, it is that money which he has withdrawn. So there is the liability that is there, it is continuing. Then the firm was solvent at the time of Devines' death, and as per the terms of partnership, the estate of the firm is jointly and severally liable because of the unlimited liability of the firm for its debts, and the money can be received even from the legal representatives of Devines, who is a partner who is no more. Then what was the contention of Devines estate? They said that no special arrangements for appropriation were made. So the principle was that the oldest deposits that were there were supposed to be repaid first. Then, because of the amount that has been paid back to Clayton, the balance has been fully discharged by payments made by the surviving partners to Clayton. So accordingly, there is nothing due from the estate of Devines for the money that is owed to Clayton. So the decision that was given by the court was that the estate of Devines is not liable as the balance has been fully discharged. So here, what is the rationale that has been used and what is the logic that has been given by the court? It said that in case of a banking account, all the amounts that are paid into the account will get blended and will form one blended firm. So you can't distinguish between this money is something that has been received on this day, this money is something which is received on the next day, etc. So that way you cannot distinguish. So it's all a whole blended fund. Then there is no room for any appropriation than which arises in the order in which the receipts and payments take place and are carried into the account. So there is no, you will have to take the total amount, and whatever money is there, you will have to pay it for the first due that is there. So if it is the first sum paid in that is first drawn out, and it is the first item on the debit side that is discharged or reduced by the first item on the credit side. So the appropriation is made by the act of setting off the two items against each other. So whatever is there in the debit side, the first credit that is coming will be used for setting off that amount. Similarly, whatever is the first sum paid in, that will be used for the which will be the first sum that is drawn out. So the credit entries in the account adjust or set off the debit entries in the chronological order. So there is something called as a first in, first out kind of a principle that is supposed to be adopted. Then old debt was cleared by subsequent. So in this particular case, the old debts that were there, the account was continuing, and whatever money was being paid out, that resulted in the old debt being discharged completely. And the debt existing at insolvency was new debt. And once it is a new debt, whatever debt is owed after the death, the partner will not be there. The debt partners or insolvent partners estate will not be liable for it. So that is the reason why there is nothing which Devines estate owes to Clayton, because whatever monies have been paid out by the firm were paid out from the same account. What would be the case if the account would have been stopped and then a new account would have been opened? Then the liability would have frozen on the date on which this partner died. And accordingly, the estate was liable jointly and severally for the portion that is due. But here, since the account was not stopped and further payments were made, wiping out the entire or discharging the entire liability, Devines estate was held not liable. So what is the rule in Clayton's case? Where the account goes into debit, like in an overdraft account, etc., the first item on the debit side is cancelled or paid out by the first item on the credit side. So appropriation is in order of time. Then suppose there is a sweep-in kind of an account where the account goes into credit. The first item on the credit side is cancelled or extinguished to pay the first item on the debit side. So here, the appropriation again is in the chronological order, and the general principle can be reduced into an acronym called FIFO, that is first in, first out. The first sum received is used to pay the first sum due. And this principle's operation is very, very important, because this will be the principle which can avoid law of limitation from applying for the earliest. If you start paying out the amounts and say that I will appropriate it for the latest dues, the dues which are pending, the first end of the entries that are there, they may be hit by limitation, because of which they may become, the recovery of which may become unenforceable. So the principle has to be to ensure that all the debts are recovered, and this FIFO principle enables that the law of limitation. um, the important to not avoid law of limitation and ensure that all the debts are payable. So you need to ensure that the law of limitation applies and no debt is struck by the limitation issue. Then what are the conditions for Clayton rules? The account should be a continuing or a running account. So examples of running accounts are your cash credit, overdraft, current account, and presently what you have in the deposit accounts, like your sweep in and sweep out kind of accounts. So here there should not be a break, and if there is a break in the account, then the rule of in Clayton's case will not apply. Then there should be no agreement contrary to the rule between the parties. So the money paid has to be applied in accordance with the expressed will of the payer and not the receiver. So if the party receiving does not agree, then what is the option that is applicable? So if someone, in the first case that I told, if 200 rupees, if someone says, if the person who's paying in, he says that this 200 has to be used for the latest transaction. Then if the person feels that the earlier dues are going to be left unpaid, he can refuse the money and then seek the enforcement of his rights, so that the law of limitation and other things will be there and he can recover the amount due from the customer. So this is the these are the conditions relating to Clayton's rule. So but what are the exceptions to the rule in Clayton's case? First, this is not applicable where there are separate accounts and transactions. So where there is a single account only, the debits and credits, how they are supposed to be adjusted, is provided for in this rule. But where there are different accounts that are there, then the principle in relation to Clayton's case will not be applicable. Then it is also not applicable where the money in a particular account is an amalgamation of both own money as well as trust money. So then in that case, what is the mechanism that is adopted is the general rule of Clayton's case will not apply. So if any withdrawal is there, so then the own money is appropriated first and then the trust funds are touched for withdrawals. Similarly, where there is any deposits, the deposits are first appropriated to the trust funds and then they are applied for the own money. Then another important exception is that it is not a rule of law. This Clayton's rule in Clayton's case is not a rule of law that has universal application and that you cannot have a term of agreement which is different from the rule in Clayton's case. So that is not how the rule is. It's merely a rule of evidence. So you could have parties having a contract where the agreement will indicate that this rule will not apply and the appropriation will be in this particular pattern. Then the rule will not apply, but the terms of agreement in terms of appropriation between the creditor and the debtor will apply. Then example of one such a thing is in case of ICICI bank credit card terms and conditions, it says unless otherwise agreed to by the ICICI bank, any payments that are made from the card member. So here, the total amount of due that is there or shown in the card statement, if that is not fully paid, how will the amount be appropriated? If there are various items of, what is it? Items which constitute the statement of accounts. So the mechanism of appropriation that is supposed to be there, unless it is agreed otherwise by ICICI bank. What is the mechanism? First, the money will be used for paying all taxes, fees, interest, costs, charges, etc. Then where there is a loan on credit cards or installment payable for a balance transfer, the next, if after interest, fees and costs, charges, etc., if there is any money remaining, then this will be used for this. Then if any money is remaining after this, then whatever installment dues for retail purchases that are there, they will be used for that. Then if there is still money remaining, then the money will go for cash withdrawals and draft on phone facility, etc. Then any other variants of balance transfer facility, if it is there, then the money will go to that. And finally, after appropriating for all this, if there is balance, then they will go for paying out the retail purchases again in the retail purchases will be in the first in, first out mechanism. So if you're going to have a credit card with balance transfer facility, then you do cash withdrawal, then you have personal loan on credit card, etc. When you are having these multiple transactions, it is going to be very, very complicated, and all your retail purchases being at the bottom rung will go and they will attract interest at 2.5% per month, which is the standard rate. So that's the reason why credit card transactions with balance transfers, then installments, etc., become very, very costly. So the rule in terms of appropriation is something which is drawn up in terms of terms in the form of terms and conditions, and these terms and conditions are agreed once you if there is an implied agreement. You make an application, and the first time you swipe, you are using the credit card, then you are deemed to have agreed to the terms and conditions of the card, and this term is a part of the terms and conditions of the credit card. So another example is what is there in the HSBC credit card appropriation. Here also you will find that the service charges, interest, finance charges, late fee, annual fee, over limit fee, etc. And finally, you will have principal, which includes purchase amount, balance transfer, cash withdrawn on credit card, etc. So these terms could be different for different cards and for different kinds of credit facilities, and you need to be aware while you are entering into this transaction. So the applicability of rule to banking transactions is something which is very, very important, and it applies to all current accounts with credit or debit balance, like current accounts, cash credit accounts, overdraft accounts, and sweep accounts as well. Then we'll see 5 cases in which the rules application becomes very significant. One is in case of death of a partner or a joint account holder and the continuance of the account. Second is civil debt, which is insolvency of a partner or a joint account holder. Then what is the position in case of a determination of a continuing guarantee, where there are series of transactions for which guarantee is continuing? What will be the impact of this rule on that continuing guarantee? Then where there is a charge on a property created and subsequently a second loan is taken against the same property, then a second charge will be created. So what will be the impact of making payments in respect of loans where there is a second charge which is created? Then what is the mechanism which is there in case of payment of decretal amount? So first, in case of death or insolvency of the partner is jointly and severally liable for the debts of the firm. So this is the general rule that is applicable under the Partnership Act. So if the account is continued after the death or insolvency, any credits for payments into the account will be used for paying off the debts due before death. So the liability of the estate of the deceased partner or the partner who is rendered insolvent will keep getting reduced, because if the account is continuing, then whatever payments will be there will get appropriated in accordance with the application of rule in Clayton'S case, and those liabilities that are there will get discharged. So the total amount due from the deceased partner's estate will keep shrinking with every payment which is made into the account. Then any debits for drawals will not bind the estate of the deceased or the insolvent, because the principle is that if a partner or a joint account holder dies or he becomes an insolvent, his liability for acts of the firm will cease from the date of death or from the date of insolvency. So any new debts that are there, or any new drawals that are there in that particular account, will be the sole responsibility of the surviving partners. So in order to prevent the application of the rule, it is important that a notice has to be given to the bank immediately for stopping the existing account, so that the liability of the firm as on the date of death or the date of insolvency is crystallized, and the liability will be apportioned between the insolvent partner's estate, then the dead partner's, the deceased partner's estates, then for the existing partners at the time when the person died or the person became insolvent. Then subsequent transactions, anyhow they are liable, so the liability of the existing partners in the firm will continue. So that is something which has to be Done. So now let us see how this operates. So the same set of transactions that we have seen in the previous example. So imagine on 9th January, one of the partner is dies or is rendered insolvent, or a joint account holder dies or is becoming insolvent. So on 9th January, what is the total due of the firm for which the estate of the deceased partner is also liable? It is 5,300 rupees, taking a total of all these transactions. Then, if the firm account is continued without discontinuing and opening a new account, then on the date of death of the partner, it has 5,300. Then the credits in the account on 11th January and 12th January 2000 and 4,000 will be appropriated for the debts which are due before his death. So 4,200 will be knocked off from the account, and the liability will be only 1,100 rupees. And the deceased partner's estate will be liable for this amount jointly and severally, or a contribution of that particular sum that is due is all that the deceased partner is liable for. Then what about the transaction that is done after the debit after the death of the partner? It will anyhow not be applicable. So the liability will not increase, but the liability will get knocked off because of the subsequent credits being apportioned with the application of the rule in Clayton's case. So that's the reason why it's more disadvantageous for the existing partners than for the deceased partner. So in the interest of the continuing partners, it is important that you stop the account and open a fresh account and continue the do the distribution of liability and get the money from the estate of the deceased person or the insolvent person. So this is a very important area where the application of Clayton's rule becomes very, very significant. Then the next is in case of a continuing guarantee. So continuing guarantee is a guarantee under section 129 of the Indian Contract Act, where the guarantee extends to a series of transactions, like in case of exports or in case of a cash credit or an overdraft account. So a series of transactions that are happening, there will be a continuing guarantee depending upon the amount that is outstanding, etc. So the moment a continuing guarantee, if someone wants to revoke, the surety wants to revoke a continuing guarantee, then he has to give a notice in writing to the creditor. So the customer may grant or stand surety for credit given by the bank for a series of transactions. Then he can revoke the same by giving a notice to the bank in writing. So in case of death or insolvency of a guarantor of continuing guarantee, the moment he dies, just like in case of a partner's account, this account has to be split and a new account has to be used for transactions that are happening henceforth. If that is not done, then the rule in Clayton's case will apply, and all the credits after death or insolvency will reduce the liability of the estate of the dead or insolvent person. And all debits that are going to be there will be the liability only of the person who is subsequently there. So banks, what they generally do to beat this Clayton's rule is not to have a split of account, but have a clause in the guarantee agreement saying that if the person dies, then the liability will be treated or determined as on the date of the death or insolvency of the person, but the account will continue to be running. So the subsequent transactions, the liability for this estate or for the insolvent estate, that will not be affected, but the account will keep continuing. So this is a mechanism where you are contracting out of the out from the application of the rule in Clayton's case. But if the rule in Clayton's case is applicable and the account is not split, then automatically any paying in from the account will reduce the liability or keep discharging the liability of the estate of the deceased persons. Then second charge of property is another instance where the Clayton's case has to be, someone has to be very cautious about because of the application of Clayton's case and the priority that will be there as a result of application of the Clayton's case, rule in Clayton's case. So what is the second charge? So suppose there is a property worth 100 rupees, then against that property as security, where a charge is created or a mortgage is created, a loan is taken, say of 50 rupees. So here the charge is first charge. Then second, again you want some more money. So against the same security, you are drawing some more. Say you are taking 25 rupees. So a loan of 25 rupees. So in that particular case, what is created is what is called as a pari passu charge or a second charge or mortgage. So with the second charge, the another account generally has to be opened because it will be two different dues, though it may be under the same security. But if they don't do that, then the operation of rule in Clayton's case will be there, and whatever amounts are there, the credits or amounts paid will reduce the amount of the first charge, because those are the debits which are happening first. So that will be reduced first. Then any debits that are happening will qualify to be debits after the second charge in terms of the priority. So this application of rule in Clayton's case is something which is very, very important in case of second charge on property. So a case in this regard is DEELAY versus Lloyd's Bank Limited, which is a 1912 case. So here G secured an overdraft for £2,500 on his account by mortgage in 1893. So that was the first loan for which a mortgage was there. Then in 1895, he raised a loan from DEELAY, the plaintiff, by second mortgage on the same property. So 2 years hence, there is this. Then Lloyd Bank, who is the banker, had notice of this transaction, but they did not split the account of G into what they owe from the bank and into what they owe insofar as the second mortgage is concerned, where their dues are for DEELAY. So several transactions were made into it. So G made payments into the account amounting to £2,500 by 1896. Then subsequently, he also made several withdrawals, but at any point of time, the overdraft draft was not more than £2,500, which was the overdraft for which the security was given by the bank. So then Lloyd Bank, when amounts were not forthcoming from G, they realized the security. Subsequently, G became insolvent. Now DEELAY also has charge on the property, so he has to recover money. He has also given a loan against the security of the same property which has been realized by realized by Lloyd's Bank. So DEELAY sued the bank on the ground that he was entitled to the security which the bank has realized, on which they had a second charge. Then the bank was responsible to him to pay the proceeds. In this particular case, the court held that DEELAY was entitled to recover the amount from the bank. And what was the rationale? The rationale was that the rule in Clayton's case was applicable in this particular case, where the amounts which were there in the original secured loan by the bank, they didn't open or split the account. So whatever amounts were paid in were used for discharging the first mortgage. And subsequently, whatever amounts were drawn subsequent to that, to the second charge which was made in favor of DEELAY. So the subsequent advances were ranking below the DEELAY's priority. So the money that had to be paid to the bank has already, in respect to the first mortgage, was already paid up because of the application of Clayton's rule. And now the bank has taken over the security, so it had to pay the money to DEELAY. And subsequently, whatever is there, they can use it as security for recovering those amounts which have been paid after the DEELAY's second mortgage has been done. So this is how the rule in Clayton's case will be applicable. Then another instance where this will be important is in case of decretal amounts payment. The general rule in case of any decree that is there where a payment is supposed to be made is the decree itself will contain directions in terms of how the payment is supposed to be adjusted. And if no direction is made, then the rule in Clayton's case will apply. So the amount will be paid first for the payment of interest and costs, and then for the principal amount. However, if the parties agree that the adjustment of the payment is supposed to be made in any other manner, then the payment can be made in that manner. Otherwise, this rule that first payment of interest and cost will be there, and then the principal amount will be there. So that will apply. So however, whoever is saying that there is an agreement against that, they have the obligation to prove that, or the burden of proof to prove that there is an agreement where this general rule is not applicable is will be there on the party who is alleging it. Then there is another case where you could have a current account where or a savings account, and the customer issues a check where he knows pretty well that there is no sufficient balance for honoring the check. But the bank has an arrangement by which it says that I am going to permit this temporary accommodation to be given to the person. So it may honor the check and honor the check and make the payment, resulting in grant of an overdraft. So the check that is being given could be treated as a loan application, and the overdraft that is granted and the mechanism of honoring of this excess drawal will be treated as an implied loan. So here, as and when there is an instance of payment of a check by the bank, each transaction will be treated as a distinct loan. And whenever there is any future deposit that is made, then these money that is there will be appropriated in the first in, first out mechanism as contemplated or as decided in the rule in Clayton's case. And the first loan that is given will be wiped off by the first credit, which will be used. The discharge, the money first paid in will be used for the discharge of that particular overdraft or loan that has been granted. And in that chronology, it will be continued. The purpose of doing this is to ensure that the recovery is not hit by Limitation Act. So this is as far as the rule in Clayton's case is concerned, where it is applicable, what are the exceptions, and what is the mechanism of contracting out, and how this rule assumes significance in case of banking transactions, especially in relation to partners accounts, in relation to joint accounts, in relation to an insolvent account, then in relation to continuing guarantee and its revocation, in relation to second charge, etc. So then payment of decretal amount, etc. So this is an important aspect, that is rule in Clayton's case, that is Devines versus Noble. Thank you.